Welcome to the Allan Small Financial Show. As I always like to say, thank you for taking the time out of your busy day to spend it with us. You know, it's always a great show day or a day to have a show when the Bank of Canada announces their latest interest rate policy. As many of you know already, Central Bank or Bank of Canada announced this morning that they are not raising interest rates once again, that they are standing pat at 5%. They made that announcement at 10 a.m. and I had the pleasure of being on TV at that time to talk about their latest interest rate announcement. And we're going to touch a bit on that later in this show, but always a good day and an exciting show when the Bank of Canada comes on right before us. We also have a lot of exciting topics for today's show, and we can put those up right now. Here we have on today's show, we have the Canadian economy. We're going to talk a bit about the Canadian economy and the slowing Canadian economy. We received data recently which told us that our economy here in our country has slowed significantly, perhaps quicker than anticipated. We're also going to have our usual This Week segment where I talk about what I believe is important for individual investors to consider over the next couple of weeks. And as usual, I have three topics that I think are important. Millennial debt jumps. Now, millennials, I always forget what age range millennials are, but millennials are in that mid-20s to low 40s age range, say 27 to 42. We're noticing that the level of debt has jumped significantly. And of course, with interest rates moving higher, the amount of interest that they're paying on this debt has moved significantly higher as well. We have a great chart to show with respect to millennials and the debt that they're taking on. Central bank rate hikes. As I mentioned just a few seconds ago, Bank of Canada came out with their interest rate policy and they've decided to stand pat. The Federal Reserve will come out with their interest rate policy a little later this month. What will they do? Will they increase interest rates or will they stay on pause, if you will? A lot of talk is that the Fed will not raise interest rates, just like the Bank of Canada, but may raise interest rates later in the year. Investors heading into the fall, jittery. As we know, when you turn the clock or turn the calendar to the month of January, I always think of it as a new year. You know, not necessarily a new calendar year, but when everybody comes back from their summer vacations and the kids go back to school, to me, that's a new year. And investors seem a little jittery heading into this new year or September. We'll talk a bit about why they're so jittery and what we're seeing. And lastly, your questions. As always, I'd like to have everyone who's watching today submit a question. Maybe it's a question on your portfolio. Maybe it's a question regarding the markets in general. Maybe something you heard this morning on TV with respect to the Bank of Canada and their interest rate decision. Whatever it may be, please submit a question to us. Love to answer it on this show. And if I don't get to your questions this show, I will hopefully be able to answer it on the next show or during the next couple of weeks before our next show. So please, if you have a question, go ahead and enter it into the chat box. I'd be happy to answer them before we, turn off on the air today. Recent data we've received started to tell us that the Canadian economy is slowing, and actually slowing possibly quicker than we anticipated. Recent data we received regarding second quarter GDP or second quarter growth actually told us the country's not growing at all. In fact, we saw our first negative number or negative growth, just negative 2.2%, but still negative nonetheless. We also saw a revision of first quarter GDP. Originally, we thought GDP came in or growth came in somewhere around 3.5%, and they revised that down to just 2.6%. So right now, we're kind of hovering just above 1% growth for the year. Maybe that's not a surprise to most people, as the Bank of Canada did say that they anticipated a growth rate of about 1% in the second half of this year. So we're kind of right on target there. However, if we do get a third quarter number that is slightly negative or in the red, that would be 2 negative quarters of GDP or negative growth, and that would mean Canada would be in a recession. Now, it may be a mild recession, but a recession nonetheless. And for most of us, if Canada is in a recession currently or about to enter into one, probably doesn't feel like a recession. I talk to a lot of people and they mention the R word. They're even afraid to say the word recession. They call it the R word. And for them, it's very bad. And of course, being in a recession is not good. However, when everybody is working, or the majority of people are working, we have unemployment still at pretty close to all-time lows. It doesn't feel as bad when people are earning a paycheck and are able to spend money. Even though GDP or growth may turn slightly negative, it doesn't feel as bad as when everybody's working. So why did GDP turn negative? Well, our first chart that we have here, a breakdown of GDP, Canadian GDP, you can clearly see why we actually ticked negative or slightly negative for the second quarter. And you have up on top there, gross domestic product turning negative. And you can see here that a lot of it had to do with inventories. We saw, I guess, a lack of buildup in inventories. Whenever you build up your inventories, whenever businesses build up inventories, that's a good thing for GDP. We also saw imports, a slowing down of imports, which is good for our deficit, but not good for GDP as well. So the negative 0.2% came as a bit of a surprise. I know Bank of Canada was anticipating a number of just above 1% growth, and they got a negative number. We have a second chart here on GDP and how much GDP has moved, or how much the growth rate in Canada has moved. And you can see how high it was coming out of the recession, right? When we first opened up, obviously things were going like gangbusters coming out of a shutdown. But as you start to move to the right on this chart and start to see numbers July 2021, you could see that we had a negative print on growth or GDP, pop back above the flat line, and really has been fluctuating between 0 and 2% for quite some time now. And right now, it is ticked just below the flat line point. So going forward, what do you expect? What does the Bank of Canada expect? Well, I think they continue to expect things to slow down. That's what they want to see. And of course, if they don't continue to see a slowdown in growth, then that will be maybe a cause to raise interest rates once again. So overall, I think from our perspective, from an investor's perspective, we kind of want that Goldilocks scenario, right? We don't want to see a recession, even if it is mild, but yet Bank of Canada doesn't want to see a lot of growth. So we kind of want to come in somewhere in the middle, kind of walking on eggshells, right? That's what the Bank of Canada is trying to do. Initiate a slowdown, but not too slow, so that we go into recession and people really start to feel the pinch. So going forward, I think it's very important to keep an eye on what our numbers look like, what our monthly numbers look like, what the overall quarter looks like, and to see if we will get a second negative quarter of GDP, which unfortunately would mean we are now in a recession. I think the Bank of Canada is not anticipating this, but we'll see what happens in the coming months ahead. Now's the part of the show that I talk about what I think is important for individual investors to consider before you make your investment decisions over the next couple of weeks. A couple of my points here we've touched on in the past, but I think they're really important right now, and they remain important. One of them, or the first one I have here, is Fed speak, Federal Reserve, or the governors. A lot of them are speaking this week. What are they saying? Inflation data. We're going to get inflation data out of the US in about a week's time. We're going to get Canadian inflation data in a couple of weeks' time. Obviously, that's going to be important for interest rate setting policy. Canadian bank earnings. We just went through the Canadian bank earnings season. For the most part, those earnings were pretty soft. I think individual investors can take a look at these banks as perhaps a good investment idea going forward. We'll touch a bit upon that as well. And last but not least, US Treasuries. The relationship between the stock market and US government bonds still exists. As US government bond rates move higher, stock market moves lower. So inversely related. And that's something we see on a daily basis. Stock market moving inversely to government treasuries or US government bonds. So let's get started and let's move to the first point, which is Fed speak or data on inflation. And we have a nice chart here, which we've shown many times, the US Consumer Price Index. And that really says it all. And you'll see here that the Consumer Price Index, 3.2%. In Canada, we're actually a little bit higher than that. But really what the Fed is looking at is this food and energy. What is the inflation rate, the core rate, less food and energy? And so this week, we've already had a few Fed officials speak. And I guess my comment on what they're saying is that they tend to be a little bit more mixed than they normally are. We've had a few Fed officials say that they think that where interest rates are right now is enough to restrict growth in the economy. It's significantly, restrictive enough so that they can see a slowdown in the demand for products, in the spending, to hopefully bring down inflation. And yet, I think as early, most recent as this morning, we heard from a Fed official saying, well, maybe one more rate hike is in the cards before the end of the year because we are still seeing strong inflation data. We received just recently, this morning, some information on services in the US, and it came in pretty strong. We also saw the price that on services that in the US right now is also really strong. So the prices on services is high and therefore factoring into inflation. So we saw that the Fed, the percentage that we could see an interest rate increase, not in September, but in November, actually tick up to between 30 and 40%. So right now there's a 30 to 40% chance that the Federal Reserve may raise rates in November. Very little chance that they're going to raise in September, but the chances are getting higher for a raise in November based on this strong services data. So overall, I believe that what the Fed governors say is even more important than what our Bank of Canada said this morning with respect to how the stock market behaves, both in the United States and here in our country. So we need to keep an eye on what Fed governors are saying. Second point that I wanted to touch on with respect to what investors should be focusing on when you make your investment decisions, as I mentioned, is Canadian bank earnings. Canadian bank earnings in general were pretty soft, right? A lot of the banks are saying lending is not as strong. What they're paying individuals to keep money at the bank is actually or has actually gone up. So the spread between what they're paying on their high interest savings accounts, for example, and what they're charging on the loans they provide, that gap is starting to shrink more and more. And we've touched on this many times. Net interest margin is a key measuring stick for our banks. And many of the banks make a lot of money when they're able to charge more for the loans they provide and not pay as much interest on those savings accounts or those GICs. So with that in mind, with the softening in the banks, with the banks saying they're setting aside, more money for potentially bad debts down the road or people defaulting on their debts, should you be looking at Canadian banks as an investment? I think you can. But if you are going to look at Canadian banks as an investment, if you are going to put money to work in our Canadian bank sector, I think you need to be patient. I don't think you're going to see the growth right away. I think you're going to have to be patient and wait for growth down the road. How far down the road? Maybe 6 to 12 months. I think you're going to have to see the Bank of Canada and Federal Reserve stop raising rates before you're going to see the banking sector gain a lot of traction. So why do you buy them today? Well, number one, I think they're very cheap. Number two, they pay a fantastic dividend as a group. You look at RBC paying a 4.5% dividend, Bank of Nova Scotia paying a 6.7% dividend, TD Bank just under 5%, BMO 5%, CIBC 6.5%. Those are your top 5 banks paying dividends that frankly, we haven't seen in quite some time. So I think you can own these banks and get paid while you wait for the growth to come. We have a nice chart here, which shows you, I guess, in general, how the banks have fared. We always show individual bank stock charts, but here, this chart, you can clearly see how our banks in general, the main banks in our country, the top 5, plus a few others in this ETF, you can see that they really haven't gained any traction. We've seen many ups and downs, but they've been pretty much range bound for quite some time. And I think for individual investors, you can extrapolate again from what the banks are telling us, how the banks are behaving. You can extrapolate that to how the economy is doing. And as we spoke about already, a slowing economy. And that's being backed up by what the banks are saying as well. The banks are telling us that they see a slowing economy as well. The banks are the bloodline for our economy. And so when the banks are struggling, when there's not as many businesses or individuals borrowing money to grow their business, when we're seeing the banks having to pay more money or more interest on the money that they want to keep, overall, this tells me that our economy is slowing down. And so banks, our economy, Bank of Canada, all goes hand in hand. So I guess my main message for our banks today is, yes, they're having a difficult time today, but that's when you want to buy them. You want to be a contrarian. You want to buy when those are fearful. And I think you can buy these banks because of the dividends, especially because of the dividends they provide, because you're going to make 4, 5, maybe almost as much as 7% dividends while you wait for the growth to come down the road. And I do believe it will come once we get by this interest rate hiking cycle. The third point I wanted to touch on that I mentioned off the top here in this segment that I think is important for individual investors to consider before you make your investment decisions, and that's U.S. Treasuries. And we seem to always have this topic or idea up for our show because it is really what is driving the bus right now. And I have a couple of charts here. 10-year U.S. Treasury. At the time this chart was taken, it was about 4.25. Treasury, U.S. Treasuries, the 10-year has fluctuated. It's gone below 10% when the data out of the U.S. seems a little weak, and it goes above 4% when the data, like we saw this morning, out of the U.S. is strong. And so again, strong data, yields rise, stock market falls, unfortunately. And we're seeing today U.S. stock market and Canadian stock market, for that matter, Toronto Stock Exchange, falling in value. And as we know, sectors like tech stocks, the tech sector tends to take it on the chin more so than other sectors. And so we're seeing the NASDAQ actually fall by greater than 1% today because of higher yields, better economic data. We have a 2-year Treasury rate as well. The U.S. 2-year Treasury, again here, just below 5%. And that seems to be fluctuating on either side of 5%. We've seen it well above 5%. We've seen it come down when we saw some weaker data or weaker inflationary data out of the U.S. recently. And that rate has come down to below 5%. But unfortunately, we've seen it above 5% just in the last month or so. So going forward, I think before you make your investment decisions, I think you want to look at those 3 things that I've highlighted. U.S. Treasuries. What are U.S. Treasuries doing? What are interest rates doing? I think you want to look at Canadian bank stocks again. Perhaps you looked at them once before and moved away from them because of some of the difficulties that you're seeing. And lastly, I think we need to pay attention to what federal governors or the Federal Reserve governors are saying right now. Do we anticipate another 1/4 point hike in rates before the end of the year? Or will they stand pat and let these previous interest rate hikes, run their course, take effect? We know that there's a lag when interest rates move higher. There's a lag, some people say 6 to 12 months before we see it take effect on the economy. So I think it's important to focus on what these Federal Reserve governors say. And going forward, I think there's be some good opportunities in the month of September. I think you just have to, sharpen your pencil, make that list, and based on the 3 points I mentioned today, look for some good opportunities and keep an eye on what's happening, especially in the with respect to the Federal Reserve and Bank of Canada. Millennials. Millennials tend to spend more than any other group. I don't know if everybody knew that. Millennials, as I said earlier, ages 27 to 42 approximately. So let's say mid-20s to the early 40s. This is the group that, I guess, has their first child or children. This is the group that will buy their first home, perhaps have a few homes. This is also the group of individuals that will have probably, or more than likely, a mortgage or tend to rack up debt, especially as they send their kids to school and different programs, as they spend money on their homes, renovating their homes, as they spend money traveling over the summer months or over Christmas time. So this group, millennials, tend to spend more than any other group. So it's no wonder that they're racking up debt at levels that we have not seen before. And we have a pretty good chart on this here, where we talk about millennials and Generation X, most stretched by debt. And I think this is a great chart to show, because you can really see over the last 20 years how much debt levels have gone up. So this is household debt to disposable income by year. And you could see here that under 35, not much change between 1999 and 2019. But when you jump to that millennial group, I guess the group would be slightly under 35, but that group 35 to 44, which are your millennials, you can see how much debt they've, I guess, increased, or the level of debt, how much it's increased over the past 20 years. You can tell that by the blue area. And 45 to 54, that too had a pretty significant increase. And 55 to 64, you're looking at about, I guess it would show you about 150% debt to income. So even people in their high income earning years, which would be ages 55 to 64, those that are just about to head into retirement, they too have a lot of debt. And 65 plus, these are individuals that you would think probably don't have a lot of debt. Hopefully, this grouping of individuals has paid down their debt. They've paid off their mortgage over time. But even still, you're looking at pretty much a debt level in that 50 to maybe 75% range, disposable income. So even that age group is starting to show us that they're taking on a lot of debt. So am I surprised to see that debt levels for millennials has risen as much as it has? Absolutely not. I talk to people all the time, and for a while, when the Bank of Canada was raising interest rates, many individuals really didn't seem to notice, didn't seem to ask me questions about it. They didn't really, I don't want to say they didn't care, because I'm sure they did, but I don't think it was as much of a worry as it is today. I think everybody started to feel the difference in interest rate policy and where interest rates are, when individuals started to get letters from their banks saying they need to increase mortgage payments. Usually, if interest rates go higher, then the actual payment doesn't change. You just pay more to interest and less to your original borrowing amount. But what has happened is, because interest rates have gone up so quickly, that the payments that people were making, just not enough even to just cover the interest alone, let alone the original amount that you borrowed. So overall, I think people started to become, I guess, maybe more jittery, more fearful, start to notice what's going on, start to notice when the Bank of Canada was having meetings. I guess recently, I've noticed that a lot of individual investors have been pulling out money from their accounts to pay down debts, to pay down higher mortgage rates. And so that's what I've been seeing. That's a trend that I've been seeing. And that is millennials as well as other age groups. So overall, am I surprised to see debt as high as it is? Not really. A lot of people are starting to use more plastic. A lot of places are forcing you to use more plastic, not taking cash, for example. card only type places. I've seen many of those in Toronto. So we are taking more debt, whether we like it or not. We are borrowing more, putting more in our visas than we have done in the past. And millennials, being that age group that spends more than any others, I think you just have to be mindful of that. I think you need to perhaps sit down, make a budget, take a look at what you're bringing in every month, take a look at what you're spending every month, because I think as long as these interest rates remain higher for longer, as we're hearing, I think people need to be a lot more mindful and cognizant of what's going on, and be under budget, be within your budget, live within your means, because things can, unfortunately, snowball very quickly, where you're paying a lot more than you're taking in on a monthly basis. As we discussed off the top of the show, our central bank, Bank of Canada, had an interest rate policy announcement this morning. They've decided to leave interest rates as they are, in that Bank of Canada rate at 5%. We have a chart here which shows how high the Bank of Canada interest rate has gone over the past, well, let's call it 1.5 years. They've raised interest rates many times. And you can see here, September 6th, top of the chart, they didn't raise. The past two meetings, they did raise. And recently, we heard that Premier of British Columbia, Mr. Eby, Premier of Ontario, Premier Ford, sent letters to the Bank of Canada and asking them to please hold off raising interest rates. And, the tone of their letters, in my opinion, was one that was saying that, maybe the Bank of Canada isn't in tune as much with what's going on the ground here in Ontario, over in BC, how much under the gun individuals are with higher rates. And we know that mortgages or mortgage debt, mortgage loans make up a very large amount of the borrowing. It's the largest debt that most people carry, lines of credit or just plain mortgages themselves. And for many people that have variable rate mortgages, we know how much those have gone up. So I think the premiers of Ontario and BC wanted to communicate with the Bank of Canada to have them, think twice about raising interest rates in the future. And to be honest, I don't think that had much of an effect on the Bank of Canada. I think the Bank of Canada was on pause for today's meeting for a while yet. But as we saw this morning, and as we like to say, hawkish, the Bank of Canada had a hawkish pause. Well, what does that mean? Well, you can use the word hawkish, or you can use the word more in terms of a pause that they said, we're pausing today, but there's a good chance that we may raise rates in the future if the data warrants. So even though they paused today, many people are fearful that they may raise rates still one more time before the end of the year. And again, I think it's going to depend on the economic data, the data that we see coming in. The Bank of Canada does not have another rate announcement for a little while as yet. So a lot of the data that they do see, data on things such as even things that they don't control, that we don't control, such as higher gasoline prices, for example, will definitely play a factor into whether Bank of Canada raises rates again. And we have another a graph here, which talks about the Bank of Canada's overnight interest rate versus the inflation rate. And I've shown this one before, but to me, the most important thing above or about this chart or graph is how much higher the bank rate now is above the inflation rate. Usually when we see that kind of disparity, that kind of difference between the two, that tells me that the interest rate hiking cycle should be and probably is coming to an end soon. And I guess the difference between the two gives the Bank of Canada a little bit of wiggle room should they decide to cut interest rates possibly in 2024. And one thing I did hear this morning from analysts is not so much about how much more they're going to hike rates. We're all talking maybe, this could be it, or maybe one and done. But when will they cut interest rates. And the talk is maybe sometime mid-2024. So Bank of Canada, Federal Reserve, they're going to have an interest rate announcement I think in a week and a half, 2 weeks' time. The talk is that they will not raise rates either. And I think for the markets, for the stock market, as I've said many times, what the Fed does and what the Fed says seems to be more important for the markets than what our Bank of Canada says. But overall, it just seems like we are getting closer to the end of the interest rate hiking cycle. And whether or not we have one more hike of interest rates in store for us remains to be seen. But I guess the data will tell us everything over the coming weeks. So why are investors so jittery as we change the calendar from August to September? Well, I think I have 3 ideas as to why. Number one, even though we did have a bit of a pullback in August for the markets, we saw the last week and a half maybe of August actually good for the markets. The markets actually moved higher. So the decline wasn't that bad. And so we entered September near a 52-week high. We also entered into September at a high valuation for the markets. And that also can be a bit of a problem. And third, September seasonally is a difficult month. We, for whatever reason, tend to struggle. People come back from their cottages. We're just getting started once again. As I said earlier, I call it a new year has begun. And when you head into September, historically the weakest month of the year, and you're coming into September at a 52-week high, at PE multiples that are at the high end for the S&P 500, somewhere in the 18 to 20 range, I think investors start to get a little bit spooked. We're starting to see short sellers making larger bets that the stock market will fall. We have a couple of charts here to show what we're talking about. The S&P 500 chart first. You can see that even though we had a bit of a downturn in the month of August, we ended the month on a bit of a high note. Not as high as where we were at the start of the month, but pretty good. So we came into September just under 4,500 on the S&P, which again, not, still down from the all-time high, which was around 4,800, but still in pretty good shape and at or near a 52-week high. The second chart that we have here, which I think is a fantastic chart, which shows PE multiples, the 10-year PE multiple ratio. And you can see when it spiked, I guess, back in 1999, we had the dot-com bubble, and then it came crashing down with the market. The PEs came down. We also saw it spike a little bit to 2 standard deviations above the norm recently, coming out of the pandemic. And then we saw PEs fall once again. So here we are, August 31st, 2023. PEs are about 1.5 standard deviations above the norm, which usually means we're a bit overvalued. And make no mistake, traders, hedge fund managers, mutual fund managers, they look at this information and they know that coming into September, a seasonally weak time of the year, and we're coming in at a strong point, or with the markets and individual investors feeling good about the markets. So, of course, the contrarian that these traders are, what do? They start to make bets that the market will pull back. And so for me, as I've said on radio show and other shows, if we can get through September in and around the break-even point for the month, I think that would be a win-win for all of us. And as we get closer to the end of the year, as we move into the fourth quarter, when we get those final interest rate announcement, and hopefully the announcement that interest rates will stay at these levels, perhaps for the foreseeable future, but that will not be any more, any further interest rate increases, I think this could set us up for a pretty good fourth quarter. So I guess the thought is coming into the fall and into the last month for the third quarter, into the start of the fourth quarter, investors are a little jittery, a little nervous about valuations, a little nervous about how well the market has done really on the back of technology and maybe even just 7 or 8 companies, the big cap tech names. We haven't seen market breadth start to pan out and to grow. So we've seen a very narrowly focused market. So that too makes things a little bit more jittery. But overall, I think if we can get through September and head into the fourth quarter, and we can hear from our central banks, Bank of Canada, Fed, things that the interest rates will be on pause heading into 2024. I think this market can gain some traction and individual investors can start to feel positive again once we get through September. So now the part of the show that I like most, when I get to answer some of your questions. And I've had a number of fantastic questions lately. Some great questions on the radio show, the Sunday Money Show this past Sunday. Individual investors texting in, and I'd love to see that. Love to see the engagement. So again, if you have any questions, please put them in the chat boxes, and we'll pick those up and answer them on subsequent shows. So here we have a bunch of questions. Perhaps we can get to a couple. Am I better to move my investments into bonds and GICs as opposed to individual stocks when interest rates or with interest rates continuing to go higher? Very good question. You know, a lot of people have moved money into money market, short-term treasuries, bonds, because they've been paying a lot higher interest. You can pick up close to 5% on a short-term money market or short-term GIC or bond. And that's enticing for individual investors because just 2 years ago, that same investment would have paid you 1.5%, 2%. You also have to keep in mind when you invest in bonds that inflation is eating away at yields returns. So if you're making 5% on a bond, inflation is 3%, your real rate of return is 2%. Whereas if you've been invested in the markets, we know the S&P 500 is up somewhere around 17, 18%. Toronto stock market is up or was up just above 5%. That is producing better returns for you than the bond market is right now, especially the S&P 500, especially the NASDAQ, which has produced returns well over 30%. So I think when it comes down to whether you should invest in bonds or whether you should invest in stocks, really comes down to the individual investor. What is your appetite for risk? What are your investment goals and objectives? What can you stomach? Can you stomach the market going down 10% in a month? Or do you just want to play it safe? So I think whether you invest in bonds and GICs or the stock market, more so is reflected on what type of investor you are than the inflation rate. We'll take a second question here quickly. If we enter into a recession, so everybody's talking about it these days, which investment sectors may be at risk of reducing their dividend payments? Again, another actually fantastic question. And I guess the best way to answer that question would be all companies are at risk of reducing their dividends at any point in time. So what do we have to go by? Well, the best indicator of how a corporation will pay dividends in the future, even during difficult times, is using history. And let's take the Canadian banks as an example. We discussed Canadian banks earlier, and we know that Canadian banks have never reduced or cut their dividend, even during the financial crisis in 2008. So even during the most dire times, Canadian bank stocks have always maintained their dividend. So I think the best way to look for individual investment ideas and look for those companies, as the question's asking, which companies would be at risk of reducing their dividends, look to how long these stocks or these companies have paid a dividend, look to see what their dividend payment history is. And I think in that way, you should be able to tell which companies' shares or which investment ideas make most sense to you if you're looking to buy investments that will provide you an income going forward. So with that, I'd like to thank everybody for joining us today on our show. I want to announce that again, we on September 6th, we have on September 20th, we have our next show, and we have a guest, Patricia Lovett-Reed. Patty Lovett-Reed will be with us. Love when Patty is on our show. Great insights in the market. As many of you know, she used to be the chief financial commentator for CTV for quite a while. She'll be coming on our show. We'll talk markets with Patty and see what her take is on what's happening at this time. And hopefully over the next couple of weeks, the markets aren't too volatile, and we'll get her take on all of that. So I just want to say thanks again. And until we meet again, happy investing.